Just talk about Washington Mutual for a second because it's down so much. Of all the times for the Attorney General of New York to sue or look to go after a company in the housing industry, this would not seem to be the time, but he's doing it and it's affected the stock.
Yeah, I mean, it's kick 'em when you're down kind of mentality here. But
and there are a whole bunch, by the way, of these class action lawsuits that are getting prepared for not only the housing stocks, but also those that have traded in these housing securities.
Yeah, this subprime ripple effect that's going on, I mean, it's going to continue much longer, and today was just sort of another indicator that it's just going to keep haunting us for a while.
And Peter, what's your thought on this?
Well, you know, it's no coincidence that the stocks that are the weakest are those stocks that are dependent on the domestic economy, that are exposed to the mortgage market and consumer credit. And those stocks that are holding up, at least nominally, are the ones that are tapping into the far more vibrant global economy. You know, there are hundreds of billions of dollars in yet to be fessed up to losses lurking in the balance sheets of these financials. We have just seen the beginning of these write-downs. There are huge losses. There are a lot of bankruptcies coming. I'm not sure which of the major brokerage firms or banks are going to go under, but there's going to be some high-profile bankruptcies, you know, even among the government, even Fannie Mae or Freddie Mac. I mean, we're going to see some problems there. They're going to be in need of a bailout. This is a real mess we got ourselves into.
Go ahead.
Well, I'll tell you, I think right now I'm going to take my cue from Bill Miller, you know, the superstar fund manager over at Legg Mason. And you know what? He just said this week that he thinks right now what we're seeing is panic selling of a lot of these financial stocks. You've heard about price for perfection. Right now this whole sector is like discounted for damnation. I mean, you've seen the S&P 500 financial stocks lose about $500 billion in market cap.
Hey,
I mean, basically they're discounting $250
Jim, we're coming up to a hard break. Mike Norman, we'll get to you in the next session of this. Stay tuned.
And Mike, you didn't get a chance to talk the last
Yeah, and I was going to say that Jim Petticockis, he's a real smart guy. He's a smart guy. You said exactly what I was going to say. Look, I think this has
Bill Miller.
Bill Miller, one of the greatest investors, you know, contrarian investors, coming out this week saying, look, this thing is getting crazy to the point of being so oversold. The financials he's talking about, he's beaten the S&P 500 for 15 years running. He's having a rough 2 years here, but he'll come back. I think he's absolutely right.
Even though prosecutors and lawsuits are lining up against these companies?
But you said something, this pile-on, that was a terrible thing. And look, I have to say, I own Washington Mutual, and ouch is what I'm going to say today. It hurts a lot, but I'm a long-term investor. And I want to just mention something. You know, Peter's talking about gold. It's easy to pick periods in time. Peter, what about the people who invested in gold in 1980? They still haven't gotten their money back. Yet the Dow was at 700.
No.
Now it's at 14,000. I can do this all day long. Stocks have outperformed, outperformed gold over the long term. In fact, stocks have been the best investment out there. And that's why I say to people, let me finish. That's why I say to people, stay long term. Stick with your investments in good quality companies. Hopefully that pay dividends and you'll be all right.
Peter, go ahead.
Let me answer this. Okay, you have to look at cycles. In 1929, the Dow was worth 20 ounces of gold. In 1932, it was worth 1 ounce of gold. In 1980, the Dow was worth 20 ounces. In 1966, the Dow was at 20 ounces of gold. And then in 1980, it was at 1 ounce of gold. Now it's at 16 ounces of gold. It's headed down. It was at 42 ounces of gold in 1980. This is a cyclical bear market in stocks and a bull market in gold. I didn't recommend that anybody buy gold in 1980. I didn't start recommending it until 1999. The people who bought gold in 1980 and lost a lot of money, that's the same thing that the people who bought stocks in 2000. 20 years later, they're still going to be down adjusted for inflation.
No, because
this is a bull market in gold. It's a bear market in stock.
Last summer, the people who bought stocks, if you were unlucky enough to put your money into the stock market in 2000, and if you had held on and reinvested your dividends, you would have went profitable by last May.
Eric?
I got a great idea.
Buy you would have been much better off buying gold.
Go ahead, Eric. Go ahead, Eric.
Buy stocks and buy gold because they're both going up from here.
You can win both ways.
Oh, come on. Gold's on it can be a $1,500 ounce and still feel the same as it did in 1980. It's got a lot of room to do.
Nicole?
All right.
Yeah, I think gold still has a lot of room to run. And I also agree with Eric on the tech plays like Cisco, Microsoft. You know, it's not going to be high growth, but there's going to be steady growth.
Okay, so 300 points, though, David, right now to the downside for the Dow Jones Industrials. Fox 50's down, S&P, NASDAQ. Why? Can anybody give a single reason? Mike?
Psychology, panic. I mean, people are just, you know, this happens from time to time, Liz. We had the 1987 stock market crash, and it had no impact on the economy whatsoever. And by the way, with the subprime, we saw the S&L crisis wipe out, you know, an enormous amount a similar situation where so many banks had to be liquidated, more as a percentage of GDP back then as what the subprime is expected to play out now, and it didn't affect
Jim Pettakakis, you know, that's not a bad thing to think about, is the S&L crisis, which at the time dominated the news. The headlines were about nothing else but S&L for about a year, and we got through it. Is it the same with the financials this time?
Well, you know, we're in the media, so a lot of us like to focus on, all the storm clouds.
That's right.
Forget about
the blood in the
sun behind
streets.
it. But you know what, Mike makes a great point. You know what, 2007 might be a lot like 1987, where you had this big market event, this big drop, and the economy just shook it off like Adrian Peterson shaking off defensive backs, for the Vikings, and it kept on moving. 1988 was a good year for the economy. I think 2008 we're going to see a reacceleration, have another good year for the economy.
By the way, just to put it in perspective, once again, we're about 2.5% down on the market today. That is a big number, that 318. But that event we were talking about back in 1987, well, that was 22% of the market.
22%. Yeah. So putting it into perspective is crucial. Go ahead, Jim.
Right. We like to just refer to that more obliquely as just an event. Okay. Not a crash.
Hold on, I think we're going to a break right now because we're getting very close to the closing bell. So stay tuned. We've got much more on Fox Business.